I'm going to go right there with our next guest, Ken Shinoda, DoubleLine portfolio manager, to really talk about that. Another 16-year high for U.S. mortgage rates. And I want to get to what that means for the impact of your portfolio and as a portfolio manager, how you're navigating that. But in the meantime, quickly, just talk to us about how you're seeing the state of the housing market with yields that, as Romain was mentioning, are expected to continue to go higher.
Sure. You know, the housing market has had quite a run. We're up over 40% from the start of the pandemic, April of 2020. And with that rise in home prices and with the dramatic rise in mortgage rates almost doubling, you've seen affordability in the housing market collapse. So as a function of that, housing activity has come to a screeching halt. When I say activity, I mean, you know, the buying and selling of homes. It's a tough market if you're an originator, a real estate broker, just nothing's going on. And then there's also other parts of the economy that benefit from housing activity, like furniture sales and things like that. But the housing market also is separate from housing prices, and home prices have thus far stayed relatively resilient. There's a lot of calls out there for an 06 to 08 global financial crisis type crash in housing, down 35, 40%. But I just don't think that's in the cards. The market's very different now. What really makes the market different today is the supply of homes. The supply of homes is extremely low. It's about 1.3 million of existing homes for sale versus about 4 million in 2007.
And Ken, to that end, therefore, affordability just not going to be alleviated in any way, despite the slowing.
That's right. I mean, affordability, unless rates fall, which could happen at some point, affordability is tough across the U.S. It's worse in certain pockets of the market. So I think home prices definitely will take a step back. You've already seen in the last 2 months about a 2% drop in home prices. We're still up on the year, probably up about 14%, depending upon what index you use. And I expect to see more softness across the market. But once that new inventory gets flushed, that's kind of been built up, you're kind of back at this low inventory levels thanks to a decade of underbuilding in the housing market. So I think that's going to be supportive of markets. What's most susceptible are some of the high-flying areas that are up 30, 40% over the last kind of year and a half or so. I think that the high flyers probably pull back the most. And some of these COVID metros where everybody had this dream of working from their mountain house.
Yeah.
Some of those areas are
it's not reality.
Yeah. I got a lot of friends who are still in their mountain houses, Ken. Meanwhile, we're schlepping to work on the subway here in New York. In all seriousness, though, I mean, when we talk about, I guess, the potential economic ramifications, broader economic ramifications of the housing slowdown, are you and the other folks over there at DoubleLine concerned at all, at least as it comes to portfolio positioning?
No, as far as what we own, I mean, we own agency mortgage-backed securities. They're government guaranteed. A pullback in home prices doesn't really affect us aside from maybe changing the prepayment assumptions that we make. And then as far as if you own mortgage credit, as long as you didn't buy it yesterday, a lot of the assets you own, the underwriting is very high quality. Borrowers have been putting 20, 30% down since post-global financial crisis. And so the chances of the same type of strategic defaults, people just walking away from their homes, is extremely low because equity in housing is near an all-time high right now.
Yeah.
I don't want to get too cute with duration and convexity. Romain and I still have those debates offline.
She does almost every day, yeah.
But how, when you think about mortgage-backed securities in the portfolio, the rate of change at which yields are rising, the impact of that negative convexity on that portfolio?
Well, with rates having moved so high, most of the mortgage universe is out of the money from a refinance standpoint. The risks in mortgages and why you get paid an additional spread over treasuries are prepayment risks. It's a risk of people either slowing down their prepayment activity or speeding up their prepayment activity. But with an almost 7% 30-year fixed rate mortgage, 91% of the mortgage universe is out of the money for 100 basis points, meaning rates could fall 100 basis points and 90% of the mortgage universe still can't refi because everyone hopefully locked in those really low mortgage rates at 3.5% a couple of years ago. So the convexity of the mortgage market, depending on what part of it you buy, is some of the best convexity that we've seen in almost a decade.
Ken, to that end, the refinancing, the fact that that has completely fallen off a cliff, speaks more to people having been savvy previously rather than suddenly being, priced out because the rates have gone so high.
That's right. I mean, a lot of people refinanced at lower mortgage rates. Anyone that, woulda, shoulda, or coulda, I think has refinanced. But, in a funny way, you're actually seeing equity takeout right now. People are still cashing out equity of their homes, even though rates are so high. Maybe it's upon the belief that this won't last. Rates will fall again, and we'll be able to refi back at lower levels. So prepayments are oddly faster than one would have expected in certain pockets of the market.
The volatility that we're seeing in the broader markets, and particularly I'm talking about in the fixed income space here, Ken, A, are you trying to take advantage of that over at DoubleLine? But B, do you think that type of volatility could actually maybe hamper some of the potential gains that I think some people are counting on already?
Look, I think as long as the Fed's hiking rates, there's this uncertainty out there. As long as inflation is high, there's uncertainty out there. So I think volatility continues, but the volatility has caused spreads to widen across the fixed income market. It's also caused, obviously, equities to come down in valuations as well. So volatility is a great time to add risk to your portfolio. It gives you a buying opportunity. We lived in this miserable world of quantitative easing where rates and spreads were so low forever and equity valuations were sky high. And now we're finally starting to normalize. Now, obviously, there's potentially more pain ahead of us. You can't turn on financial media without listening about calls of 3,000, 3,200, 3,400 in the S&P. But for long-term investors, when you get down to those levels in equities, and when you get to the kind of almost the levels we're at in fixed income now, we haven't seen all-in yields on pockets of the fixed income market, from high quality to intermediate risk to high risks in over a decade. So for long-term investors, I think you can make money over a 12 to 24-month time horizon. You may have a negative return because rates move higher or spreads move wider in the near term, but for long-term investors, they should all be taking a hard look at fixed income because it finally, after 10 years, it can provide an alternative to
Finally. Ken, quickly here, you mentioned that the credit quality of the underlying loans and the underlying portfolio still looks relatively strong. What assumptions, when you think about the health of the consumer, a recession, would change that call to where you don't really like the underlying credit of those portfolios?
It's tough to say because since the global financial crisis, we made in the U.S. mortgage underwriting so strict. So average credit scores are way higher. Average money down is much lower. And we have tools like forbearance that we put borrowers in during the pandemic that you could use to create lower losses in the mortgage market. So I think that it would take a very deep and harsh recession with unemployment at extremely elevated levels, up kind of near where they were during the global financial crisis, to start really getting concerned about deep losses in mortgage credit.
All right. Hey, Ken, always wonderful to catch up with you. Some smart stuff. Ken Shinoda there, DoubleLine portfolio manager, helping to kick off today's Triple Take.